Hello and welcome back to The Motivating Force. Joining me as always, we have host Sway, an aspiring Marine Corps officer who is currently finishing up ROTC and his bachelor's in the criminal justice field. And myself, Justin, a motivational speaker who's always more than happy to share wonderful ideas and topics with you guys. Jumping right into it this Monday, we're going to be talking about some of those first baby steps towards financial literacy and just getting your bearings with your finances. We know times have been tough with the coronavirus, and that has affected a lot of people's paychecks. But recently, everybody just got that stimmy. And we also got our tax returns. So people are sitting on a pretty good chunk of money right now, and we're going to talk about things you should be doing with that, and also things you should be doing with your money in general.
Yeah, a big problem that we're seeing a lot recently is since people have been struggling with finances because of COVID, now that they're getting all these different things coming in at the same time, like you mentioned, the tax return, and then that stimmy hitting, they want to just blow everything. So, I'm pretty sure we have some tips that we're going to give people on how to use that properly instead of just blowing all their money.
The first step would be to get out there and go buy the new Gucci Air Force Max 10,000s, right?
Oh, yeah. Do all that. Get all that expensive jewelry, too, while you're at it.
Yeah. And I guess pay your bills if you have some of those sitting around, right?
The PlayStation 5. You can't not buy that right now.
True. Yeah, because those go for about the price of the stimulus check right now. Yeah. No, but in all seriousness, I think one of the first steps that I really wanted to talk about here, I know when people start searching up things for, managing their finances, they get all these percentage rules. And a really popular rule is the 70-20-10 rule, okay? And basically what that covers is you should be living off of 70% of your income. That should cover all of your expenses, all of your bills, everything. 20% of your money should go towards debt or savings. And 10% of your money should go towards investing or donations. Now, here's where I kind of have a problem coming into this rule here, because it is going to be the first thing everybody sees, and I'm like, man, it's kind of got off on the wrong foot, because there's a lot of things that sound good about it and sound right. So living off of 70% of your income, to me, yeah, okay, that sounds about right. But doing the 20% towards debt or savings, it sounds right if you have debt, but it's not right for your savings account. And then again, the 10%, if you're doing donations or such things like tithing or something like that, then obviously, yeah, that sounds right. That makes sense. But for investing, again, now that's the part that doesn't sound right to me. And here's a couple reasons why. Personally, I'm a firm believer in a nest egg system.
Yeah, we've talked about that before, so this shouldn't be that new of a topic for our listeners. And then again, this is a disclaimer, right? Because we aren't talking about, like we mentioned the stimmy and the tax returns, but what we're talking about now is that normal income that you're receiving, those normal paychecks that you should be getting if you're lucky enough to, still have that job, still be financially stable. We're then going to talk about the people that have fallen into debt because of COVID. But right now, you are just talking the 70-20-10 rule is about the people making that normal income.
Yeah. Okay. And to cover up real quick with, the tax returns and the stimulus checks and all that, like all jokes aside, honestly, 90% of that should go towards your debt if you're in any type of debt. Just hands up, like that's it.
Yeah.
And 10% of that should go towards anything you want.
Yeah.
Because, there's a saying about money that you come into, which isn't something that you typically like work hard for, like bonuses at the end of the year, hitting like lottery, scratch off, something like that. And again, with tax returns and stimulus, like which money you run into, you should always take 10% of it. Don't even think about what to spend it on, and spend on whatever you want.
Yeah. It's that like free money.
Yeah. And it's going to keep you from, splurging on the rest of it, because you are going to limit yourself to that. And that other 90%, pay off those debts, man. I know everybody's got them right now with everything going on. So don't even worry about saving it, nothing. Just get those debts paid down, because it's great to save money. But at the same time, if you owe money, you're paying interest on that money you owe.
Yeah.
So who's really winning at the end of the day? But getting back into this 70-20-10 rule, It is a great role because it does help people understand budgeting. But the issue I find with it is you got people running all these percentages and all these numbers, and that can get overwhelming.
Yeah, complicated for those that don't understand percentages to begin with.
Right. And especially people just, paycheck to paycheck, and you want to make this change. And you're like, yeah, it's real simple. We're going to take every single penny you earn and break it down to a percentage and tell you what to do with it. Does that sound simple, though?
Yeah.
So back into the nest egg, you should, figure out your monthly expenses and then make sure it's within that 70% range. But figure out what you actually spend every month on, your rent, your car payment, insurance, phone, all that stuff. And times that by 6. So 6 months, throw that into a savings account. Don't touch it. Don't even pretend it's there. That's your emergency fund. That's the nest egg. And you are going to have to revisit that every year because inflation's a real thing. Inflation's happening with every stimulus check you get as we create money from thin air. But again, I digress from that.
But real quick, going off that point that you were saying about having to calculate that budget, speaking from example and as somebody that has struggled in finances, and I've also talked about that and kind of brushed over the path that I took to get out of that like debt and that struggle and stress that it brought me. That's probably the hardest part, is having to admit to yourself what you're actually spending your money on. And a lot of people will probably struggle in, like you don't really want to put down that number because then you're probably going to see that it's higher than what you're actually gaining. And that's why you're in so much debt. So having to trim off the fat of the stuff that you don't need, it's very crucial to this because you're trying to save money. You're trying to build up that bank account and have a savings instead of blowing more than you're making.
Yeah, exactly. But see, that's why I kind of do disagree with this rule. And this is kind of the premise of that, like the alternative that I'm suggesting to it. And of course, I'm no financial expert or manager, whatever you want to call those people. But, just from experience, because this is what I do. And the 70-20-10 rule, I don't think is going to work for most people. The first thing you need to do is you need to pay off all of your debt, and then you need to build a nest egg. And then once you have that done, the rest of the money you earn that you're not spending on just living needs to be invested. Because I don't think it can get any easier than that.
Yeah. And we're talking investment like stocks or real estate. What are we talking? Because I know, the media has been pushing like cryptocurrencies and stock markets all over the news now. So it's like, are we touching on stocks and investment because it's the hot thing, or is it the smarter thing?
We're definitely 100% touching on stocks because it's hot and trending.
Yeah.
And it is a smart move just because of the principle that it teaches people and how to manage their money. But currently, really, I guess the smartest move would be investing into real estate. Yeah. Doing REITs and things like that.
But you need a bigger down payment in order to start real estate investment, right?
You do.
As opposed to spending a couple $100 on stocks and then getting that return, right?
Well, that's the beautiful thing about using REITs, REITs, which are basically an investment portfolio that you can use where, and a lot of it is through stocks too, actually, but you're putting money into real estate firms. And then you get paid percentages back on that through dividends, then of course through increase in the company. And right now, that industry is going to be booming like crazy.
Yeah.
So that's definitely a really smart move. But back to the basics, people should be focused on stocks.
Yeah.
Because the stock market, over the longevity of your life, you're going to make money. It's going to go up.
Yeah.
And it's not that it has to be anything crazy, but even just based off the fact of inflation, it's going to go up. It's going to balance and it's going to match that. Whereas your bank account, it's not.
Well, before we get too off topic, I feel like that is important to, touch up on before what you were talking about REITs, because I didn't even know about that. So it's like, for people that are trying to start investment in general, the point I was trying to make with the whole stock market conversation was there are other options instead of just stock market that you can just look into and expand your knowledge upon because I had no idea that, REITs was a thing. I thought you just have to buy a lot or buy a house and then you're flipping it, selling it, or just renting it out. That's what my understanding of real estate investment was. So there's little things like that can change your opinion of investment in general, where you're giving them a percentage and they're just giving you a percentage back because they're the ones that own the lot, right? That's what you're...
I'm trying to think of the name of it off the top of my head, but I can't. Because aside from the stock market, there are agencies that kind of handle that for you. Yeah. And I will put right here, you guys will see the one of the websites for that. And it is somewhere where you go invest your money and it goes directly to management companies, whether it's new projects, it's apartment complex management.
Like holding corporations?
Yeah.
They take the money and then they kind of split it where it can be profitable.
Yeah. And you can even pick. And what's really cool about it is when you pick the firms or the portion of the industry you want them to put your money into, when they finally designate it somewhere, it'll tell you exactly what company and who has your money and what building properties you're investing in. And you can even right there through the website go through and look at pictures of the building process, reports from that management company if it is an apartment complex, and you can always pull up those apartment complexes and look at them.
Yeah,
but see where your money is.
Yeah, this is why I'm saying this is a great point to actually touch on, because we're always pushing to do the research and look into these things and know more about it if you're interested in it. And for the common person that just hears investment, they're only thinking stocks. So it's there's so many different opportunities for you to grow that financial, that nest egg you're talking about. And I just felt, I needed to bring that point up.
No, it's true. I'm glad you did, because, stocks don't make sense to everybody, and that's okay. Because if you're going to be putting your money somewhere, you need to put it into something that makes sense for you.
Yeah, you need to be confident about it. You can't be doubting it 24/7, and that's not going to be good for your mental health either.
Yeah, exactly. It's just going to bring you more stress than anything, even if the money is growing, right? And you're like, I have no idea how it's happening, but it is.
Yeah.
It's not really a good thing. So, yeah, you should definitely, there's so many different forms of investing out there. The safest going all the way down to getting CDs from your bank, where your money just gets stored away for 5 years and they give you returns on that. To things like these holding firms that invest in real estate for you. And then, of course, the simplest one being the stock market, because I think it's the accessibility of it and the user-friendly. You got the stock market on your phone nowadays.
Yeah. And that's another reason why we're touching on it, because it's so common. Everybody's talking about it. I'm sure 80% of our audience right now has some kind of stock market app on their phone, because Bitcoin, Dogecoin, whatever the hell.
Yeah.
So
I'll tell you, they should have a stock market app on their phone, even just to see what's going on in the world, right? But we are going to be talking mostly about stocks today with this, because I kind of took how I wasn't a big fan of that 70-20-10 rule, and then I kind of created my own 70-20-10 rule when it comes to investing in the stock market. I personally invest in stocks compared to doing the other things. And of course, like we're saying, there's all other things out there for you if you're not happy with the stock market. But the 70-20-10 rule that I use in the stock market, I think will make a lot of people happy with where they're putting money.
Okay.
Because I don't want to say it's going to be, your best return on investment or anything like that, because I'm not here to, tell you you're going to be a millionaire in a year if you follow this plan.
Yeah.
But what I'm going to tell you is I'm going to make you feel confident in investing in stocks. And here's how we're going to do that. This portion of the 70-20-10 rule just goes towards your investment money, not what you're making every month.
Okay.
So keep that in mind.
So this is already pre-budget. This is the money that you have set aside for that purpose entirely. Okay. And all your bills are paid with the other, your normal checks. You're getting all that stuff situated. This is investment budget.
Investment budget, yes.
Okay.
This is what you're going to do with your investment money.
Got it.
What we're going to do is we're going to take that original 70% of that investment money and we're going to drop it into a high yield dividend portfolio.
Okay.
A couple different ways to do that on the stock markets. You have ETFs that already kind of pick high yield dividend stocks, kind of bundle them all together, like 100 different companies, and you can put your money into that. It's the safest, easiest way. It's the least amount of research for you.
Yeah.
It's simple. Because that's literally what they're even called. I don't even have to explain that. You just Google high yield dividend stocks and ETFs, and it's going to come up like crazy.
And these are for long-term investors, right? These are, you just kind of leave it and forget it.
This is your long-term investment. Yes, this is why it's the majority of your investment, 70% of it.
Yeah.
Because on these ETFs, you'll see usually 5 to 8% back on the dividend yield annually. But if you go out there and you pick your own stocks that are high dividend yield and you do your research right, you can net anywhere from 8 to 12%.
Yeah.
So, of course, the diversity is not there as much because you're picking specific companies. But, you know, you go through the history of the company. If they've been doing it for the last 5 years, I don't think you're going to have a problem anytime soon, right?
Yeah.
And I kind of feel like there's more of an importance to kind of pick your own because you know what you're getting into. And it's a good eye-opener into the world of stock markets.
Well, yeah, and business in general. You get to expand your knowledge on what the company's actually doing. Instead of just thinking of like places like Amazon and going, oh yeah, they're just online retailers, you know, they ship me stuff. If you buy stocks in Amazon or things like that, you can actually do that groundwork to research it and actually have a better understanding of what they're doing as a company.
Yeah. And as a company, they just take your money because I don't think Amazon even pays a dividend.
Well, I'm not saying for a dividend example, but I'm saying like companies in general, whatever you do end up investing in. It's a great example of being able to understand more of that like business layout of what they do as a company.
It's great to open up your mind to it for sure. Yeah. So the real simple principle of it is that this is all compound interest. So we're talking long-term investment because it's over time, and over time your money's going to compound. So whereas 10% doesn't sound like a lot, 10% doubles your money every 7 years.
Yeah.
Something to think about. So this is going to be the majority of the portfolio because you are counting on a dividend payout to get you more money. You're not really counting on the stock price to go up for it.
Yeah.
So obviously the more money you have there, the better it is for you because, again, compound interest, that's how it works. You want your larger number here. And the next step is what you're going to do with the 20% of that investment money that you had sitting around. With that 20% of your investments, this is where I want you guys to go a little bit crazier, right? Yeah. We're going to go into cryptocurrencies and we're going to go into higher risk. There is a lot of money to be made with like high risk, high reward, right? Mm-hmm. And there's a lot of money you can make when you do swing trading. And it's going to be a lot more than 10% a year. But the problem with that is it can also go the other way really fast.
Yeah, you could lose a lot real quick.
You can. And this is where like the whole GameStop thing. The GameStop stock going through the roof. People making, 1,000% on their money in a matter of a month.
Yeah.
But then you get these kids that are like, oh, I can do that. And they think that's how the stock market is.
Well, they also think that putting $10 down for GameStop stock is going to get them millions of dollars in return.
Yeah.
No. You have to put a lot to then flip that as a lot. The more you put in, the higher percentage changes that result for you.
The point being is, of course, like that's the example of something that worked out really well for people. And then I know some people that saw it going up, right? GameStop that was like $10 and now it was up to $350.
Yeah.
I know people that bought in at $350 on that because they're like, no, it's going to keep going up.
Yeah.
It went from $10 to $350. What is it going to go to next? $1 million?
Yeah.
You know? No. Come on. But it's because people don't know these things.
Yeah, that's why you have to have the knowledge of what you're getting into beforehand. That's why we're talking about this, so then you don't do that.
Yeah.
That's why you have to be like confident is the word we used earlier on the actual investments. You want to feel safe. 350% increase doesn't seem like the right time to buy in.
You definitely missed it.
Yeah.
But there is always that fear of missing out. But conversation for another day. You're going to take that 20%. You're going to invest it into a higher risk type of thing. You're going to use it as you would the normal stock market. Personally, I would like if you guys kept all this in the same portfolio.
Yeah.
Because what's going to happen is if you start winning on those risks and you watch that account blow up, you're going to feel great about it. If you start losing on those risks, as soon as that quarter comes to an end and your dividends kick in and you get that money from the dividend payout, you're not going to feel so bad about losing because you're still making money in that portfolio.
Okay.
And again, back to the confidence. That's really what you need. And if you just watch yourself get beat up one too many times on a high risk stock and you have nothing there that's going to keep the money growing back in and you just put 20% and you watch it keep getting thrown away, how are you going to feel about that?
Okay, so what you're talking about is keeping the long-term investing, those dividend stocks, and the swing trades in the same portfolio.
Yeah.
You're not talking about all the other 20% swing trade stocks that you're trading, keeping that in the same portfolio. You're talking about the whole thing.
The whole thing.
Okay.
Yeah, the whole thing, the whole big picture for it. Because, again, back to this being like that kind of like first step into taking care of your finances. This is really just something you're going to practice maybe 2 to 3 years, at most. Because then by that point, I mean, you're going to know enough to kind of get out there and do your own thing and really, really grow yourself. But this is just to get your foot in the door. So this is definitely for your beginning investors, people just learning what to do with money. So being able to cover up those losses will definitely handle or mitigate a lot of that discouragement you're going to get from getting those losses in the first place. And lastly, the last 10% of your investment money, I want you guys, as cliche as it sounds, to invest it into yourself. So this money should go towards your education. Whether it's books, ebooks, subscriptions to, I would say magazines, but that's my age, I guess, coming out. But like, Forbes.com or, the Wall Street Journal and it doesn't even have to be finances or stocks, just like anything that you find interesting, right? As we talked about before with turning hobbies into profits for yourself.
Yeah. Just
anything you're interested in, take 10% of your investment money, invest it into yourself by gaining more knowledge. And again, with that, like if your favorite thing is like playing video games, I'm not telling you to take 10% and go buy like a new graphics card with it, but like take 10% of that money and go invest it into like gaming development companies, or just getting out there and researching more into that, like strictly the educational side of your hobbies.
Or what about what we're talking about right now and stocks? If you really are liking this, the 70 being put into that long-term investment, and then the 20% you're throwing into swing trades, but you really want to get a better understanding of how to do that, a little bit more with a higher turnaround rate, put that 10% into different stock classes. There's websites, there's people that offer their classes, and what is it, like a masterclass thing that they can do? You can put that 10% into purchasing one of those and get a better understanding of how the actual broker works, so then you can use that to the best of your ability and get a higher turnaround rate. If you're going to be committed to this investing path, find the education to boost your knowledge in investing.
Yeah, because it's like even using Course Hero, you have that. And that website, you can buy courses for anything. You can learn how to draw from taking courses on that website. Definitely something to look into. But I think that just using that last little 10% of your little 10% there, it's going to help keep you motivated. It's going to help keep you in the right direction. And it's a goal you should really set for yourself, because when you look at courses, especially courses like books aren't really that expensive. So that's kind of no factor for you. But when you start looking at these courses and you're like, man, I'm going to pay $120 for somebody to teach me something that I can learn on YouTube.
Yeah.
You're going to start feeling some way about it until you actually start taking them, because you're like, okay, well, I do have that money allotted. Let's just take it. Let's do it. Let's see how it goes. And then you realize that value of what it takes to actually pay somebody online to get information versus just Googling things and hoping for the best.
Yeah. But I feel like that goes a long way with like knowledge and having a portfolio that works out for you, and essentially just saving and building that nest egg that we're talking about. Because especially now that everybody's just trying to spend the stimmy and the taxes on whatever, and the first thing that passes their mind, that's bad. You want people to be smart about their money. You want people that want that structured life. They don't want to keep going in and out of debt. You want them to really focus in on something that, last year, stocks probably seemed like impossible and super complicated for everybody. But thanks to this whole GameStop thing and AMC, these stocks that got super popular in the media, investing in stocks became a whole lot simpler when people started at least putting their foot in the door, trying to understand it and getting the apps to at least like how do graphs work? I'm sure public high schools in the US didn't do a great job teaching you how to invest your money. So at least starting it now is a good idea for people to like get their life in the right direction.
I think that's what really brought it up, though, was seeing the popularity of that, and some of my coworkers that might not have the best financial literacy that are like, oh yeah, I'm doing stocks now too and all this stuff. And they're like, yeah, I put $10 into this the other day. Yeah. I put $15 into this the other day. And it's like,
so you're getting $1 back from it?
Maybe,
yeah.
Right. So it's like, are you doing stocks, or are you just kind of wasting your time?
Yeah. The smarter alternative, if they only have that $15 or $10, why don't they just keep holding it? Just throw it into the stock portfolio, but don't buy anything yet. Wait until you have the $200, the $300 to then buy stocks. But don't do $15, $10 at a time. Yeah, that comes with knowledge of investing and, you know, the minimum research that you can do on YouTube if you're looking for that free information.
That growth is not going to make you feel too good about it, that's for sure. So just closing out here, we wish everybody the best, and the best with your money, with that stimulus check, with the tax returns, everything, all those extra pennies you're seeing in your account right now. Take a double look at it before you spend it, at least. You know, if we can get you guys to start saving a little bit, investing a little bit, we'd love for you guys to do that. It's going to be great towards living a structured life, because your finances are obviously a big part of that. And we just want to see everybody do well.
And wanting to see everybody do well, we also hope to see everybody on Wednesday for our Wednesday episode. We're going to be having a very interesting topic, and that's going to come out 8 a.m. on Wednesday. Remember, you can also check out our Instagram, Facebook, and Parler accounts. We're going to be putting a bunch of clips on there. It's going to be great. You guys can also interact with us down in the comments or on those social media pages. All of our episodes come out Mondays, Wednesdays, and Sundays at 8 a.m. EST. And until next time, go and get.